During a period of market volatility, which is what we're seeing right now, it's difficult for someone with a large lump sum to invest to put it all into the market in one go. The reason for that is that they're scared of a market crash, and they may try to hold back the money thinking that there'll be a better entry point at some point in the future. In other words, they'll try and time the market. So one way around that is to drip feed into the market or dollar cost average into the market over some period of time. But that begs the question, what is the best period of time to do that? So in this video, we'll look at the statistics of that and also the kind of environments in which it is best to dollar cost average rather than lump sum invest. So let's look at that in a bit more detail. So what is dollar cost averaging? Well, it's nothing to do with currencies. This works for sterling, for euros, or even for dollars. The idea is that instead of that lump sum going into the market immediately, you continually invest your money on a regular schedule. Now, that could be because you're receiving money from your salary, or it could be simply that you've got a lump sum and you're splitting the investment of that lump sum over some period of time. But it's the latter definition which we'll be considering in this video. Should you invest everything in one go, or should you spread that large lump sum over multiple payments? Another name for this is drip feeding versus lump sum investing. Now, the reason why it's usually better to immediately put your money into the markets and not hold it back at all is that markets drift up over time. Of course, there are big crashes, but if you look at this time series, this is the total real return for the S&P 500 going back to 1870, you can see that the trend is very clearly upwards. It's also exponential, so that I had to use a log plot just to make it fit on the graph and look sane. But despite that, you can see that most of the time markets rise. So most of the time, you're better off putting money in straight away. The only exception to that will be just before a market crash. But unfortunately, although in retrospect we can see those crashes, such as here in 1929, and here in 2000, and here in 2007, when you're actually at the coalface in real time, you can't know that there's a crash coming. So in this video, what we'll be comparing is what we've got in this top panel here, which is you put money into the markets. So let's say it's $120,000, and then you wait some period of time, and then you see what it's worth. So you could sell it for, say, $130,000. And what we'll compare that with is taking that $120,000 and splitting it up into lots of chunks of equal size. So the comparison in this case would be 12 equal installments of $10,000 each. And then what we'll do is look at the value of those two different approaches calculated over the same period of time to see which is worth the most. So in this case, would the dollar cost averaged 120K be worth more than the lump sum invested, 120K? Now, Vanguard's already done a research note which looked at this comparison, and the name of it was Invest Now or Temporarily Hold Your Cash. And they did it for 3 markets. They did it for the US, for the UK, and Australia. And their labels here are immediate, that's lump sum, or systematic, which means a 12-month drip feed. And what they found was that in about 2/3 of the cases, in all 3 markets, the lump sum approach outperformed the systematic or drip feed approach. And in this bottom panel, you can see they're comparing the size of the outperformance. And in fact, it wasn't that large. It was only around 2%. So assuming we're going to compare lump sum investing with drip feeding, the question is, how long should you drip feed over? So what I've shown here is the outperformance of drip feeding versus lump sum investing. So if we're above the dashed red line beneath me, that means that drip feeding is outperformed. And if we're below the dashed red line, which is most of the examples as it turns out, then lump sum investing has beaten drip feeding. And what I've done is 5 different periods for the drip feed, ranging from 12 months, so that's this column here, all the way up to a 60-month period or 5 years for the drip feed, which is pretty extreme. Vanguard actually recommends 12 months. So these boxes you can see on the graph represent 50% of the examples. And then the horizontal white line is the typical or median outperformance. Notice that that's always negative. In other words, lump sum investing on average beat dollar cost averaging or drip feeding. In fact, if we look at the size of the underperformance of the drip feed as we vary that drip feed period, you can see that it increases by about 3% for every year that we drip feed. So we can come up with this really nice rule of thumb, which is that the longer you drip feed, the more you lose relative to a lump sum approach. And if we look at the size of that underperformance, it's about 3% for every year that you drip feed over. So given that drip feed investing almost always underperforms lump sum investing, why would you ever choose to do it? Well, the answer is to do with remorse. And as Rousseau says in this quote beside me, remorse sleeps during prosperity, but awakes bitter consciousness during adversity. So let's imagine a scenario in which you invested, say, $1 million, and then literally overnight the market halves. That's pretty unlikely, but it could happen. Imagine the remorse that you'd feel. How could you minimize that remorse? Well, you could drip feed, because you'd have only invested 1/12 of your million if you were investing, say, over a 12-month period. So you could see this drip feeding approach as a remorse minimization strategy. Now, if I speak to people one-to-one, they often give me reasons why they're not investing their money, why they're holding it back in the form of cash. So for example, they might say, if I wait a bit longer and markets are now falling, surely I can buy it at a cheaper price later on. They sometimes even say that when markets are rallying. Or they have no faith that markets will recover. They have lots of reasons why markets will fall, because there are lots of stories in the media about that kind of thing. That's what people like. But if we actually look at the facts, as we did at the beginning, markets usually rise, despite all the bad news headlines and all the pessimism which is out there. Optimism should be your default setting. Or sometimes people tell me markets surely can't go any higher. Look, they're at all-time records. But of course, there is no limit to the upside for equity. By definition, that's why it's such a great asset class. Its upside is unlimited. So that's why I think for many people, including myself, drip feeding into the markets is actually a good thing, because it stops you from holding back from the market and it ensures that you get that market exposure. It also stops you from trying to time the market, because we never know when a crash is going to happen. So holding back our cash in case a crash does happen is usually suboptimal. And that's why you've probably heard people trot out the phrase, time in the market is better than timing the market. It's more likely to succeed. So by drip feeding, you overcome your fear and you stop holding back your money from equity and allow yourself to succeed. Now, in fact, there are some cases where drip feeding does better than lump sum investing, which we'll look at in a second. Before we do that, let me just quickly mention our membership, which we now run on our website, PensionCraft.com. And if you do join us, then you get access to Slack, so you can ask me a question anytime you like, or other members of the community who collectively know more than me. Plus, you get access to a growing library of members-only video content. You can now join our membership on PensionCraft.com. To learn more about that, just click on the link beside me or in the description beneath me. In certain environments, drip feeding has a higher probability of outperforming lump sum investing. And if we look at the best and worst case, it'll give us an intuition for when that is. So here I've looked back over 140 years to see which was the best 2-year period for drip feeding versus lump sum investing. Now, of course, that'll be when the market's trending downwards, and in this case, it was trending downwards very sharply between 1930 and 1932. What's also interesting is that when we start that drip feed period, the valuation, according to Robert Shiller's CAPE measure, is actually quite high. It's at around 25. And of course, by the end of the period, the valuation's much lower. It's below 10. So while we can look at the CAPE measure at any point in time, of course, we'll never know when a crash is about to happen. So the top panel doesn't really help us, but the bottom panel does. Now let's look at the worst case over that 140-year period. And what's kind of interesting is that it was very recent. It was the period between 2020 and 2022, when we had that blistering rally. Valuations were not incredibly cheap during that trough in 2020, but they weren't hugely expensive either. But because equity markets rallied so strongly, the outperformance of lump sum investing was absolutely huge. You'd have been much better off investing in March 2020 rather than drip feeding that over a 2-year period. One of the factors which tilts the odds in favor of drip feed investing over lump sum investing is valuation. So this graph beside me is the same as the one we saw previously, but I've got all 5 periods I looked at. That's from between a 1-year and 5-year drip feed period, and I've grouped those into 5 groups. And that grouping is according to the valuation at the start of the period. So if markets started off expensive at the beginning of the drip feed period, we'd be on the right-hand side. And if markets started off cheap at the beginning of the period, we'd be on the left-hand side. Now notice the typical case is still always for lump sum investing to beat drip feeding. That's the horizontal white bars you can see here. They're always below zero. But what's interesting is when valuations are particularly high, as they are here on the right, firstly, the typical cases don't show so much underperformance, but also the extreme outliers where drip feeding hugely outperforms lump sum investing tend to be larger. So that begs the question, where are we right now with valuation? And Robert Shiller's CAPE measure is currently at 33 times. It's still very elevated. So that in fact favors the odds of drip feeding at the moment. And if we look at the historic value of Shiller's CAPE measure, you can see that its current value of 33 is very elevated. It's well above the 75th percentile and even further above the 50th percentile, which is the median. One criticism of CAPE is that it didn't take interest rates into account, and it's looked very expensive for a very long period of time. So Robert Shiller came up with something called the excess CAPE yield, but it turns out that tells a very similar story. The only difference in this graph that you can see beside me is that expensive is now on the left-hand side rather than the right-hand side. So when the excess CAPE yield is low, that means equity markets are cheap. And this valuation measure does take interest rates into account. Now, according to this measure, currently markets aren't as expensive as they are for, say, CAPE. So now we're only in the 4th quintile of expensiveness. So by this measure, it isn't as attractive right now to drip feed. It doesn't seem to have made a huge difference to the typical cases or to the outliers. But certainly if you look at the cases when the market's very cheap, according to excess CAPE yield, it's very unfavorable to drip feed in that kind of environment. But we're far from that position in the present day. So here's the excess CAPE yield history going back to 1960, where cheap is at the top of the graph and expensive is at the bottom, and the current value is 2.5. Now that's below the median, so that shows that markets are a little bit expensive. Not hugely, but just a little bit. And that's why this measure isn't as helpful at the moment. It's most informative when we're at the extremes of the excess CAPE yield distribution. Now, some people think that after a market crash, in other words, a correction or a bear market, this would be a better time to drip feed. It turns out that's not the case. So now the x-axis is grouped according to whether we're near an all-time high, so that's the right-hand block here, versus larger drawdowns relative to the previous all-time high. So this block is between minus 0.5% and minus 8%. This block is between minus 8% relative to the all-time high down to minus 23%. And the final block is for very deep drawdowns indeed. So that's minus 23% to the historic high of 77%. And really what's pretty clear is that the distribution doesn't really change much. If anything, drip feeding when we're close to all-time highs has the highest outlier outcomes for drip feeding. But certainly the typical cases, which are the medians, the white bars, really don't seem to be affected by how large the drawdown is relative to the previous all-time high. So in conclusion then, if you are investing as you earn money, so you've got a steady stream of income, you set aside a certain amount every month, and then you invest that in the equity market, just carry on doing that for the rest of your career. It really doesn't pay to hold back money from the equity market because of its upward drift. So in that case, you really don't have a choice as to whether you dollar cost average. By your very nature, you're a dollar cost averager or a drip feeder. And also, the base case is that drip feeding is unlikely to work relative to lump sum investing. The statistics are pretty much overwhelming if we look at the history. But that's not to say that certain factors don't tilt the odds in favor of dollar cost averaging slightly. And valuation is probably the most important one. However, as we saw, whether we've crashed recently isn't a good measure unless that's also reduced the valuation of markets, which isn't always the case. But when we come to decide what period of time is best for drip feeding, usually the shorter the better. So 1 year is usually enough for a drip feed period. It's really hard to justify holding back your money for longer than that. So I think in some cases, it can make sense for people to dollar cost average if they have a large lump sum to invest. But remember, most of the time it'll be suboptimal, so try to keep the period as short as possible. Also, don't forget that if you are going to do it, put a calendar reminder every month and stick to that schedule. If you're holding back even for a day, you are timing the market. And remember, what matters is time in the market. Now, don't forget our membership offer that's now run on our website, PensionCraft.com. You can learn more about that by clicking on the link beside me and in the description beneath me. And as always, thank you for listening.